Today, the CBA result, a matter of perspective. Hello again, it's Martin North from Digital Finance Analytics, welcome to the latest post covering finance and property news with a distinctively Australian flavour. One of our largest banks, the Commonwealth Bank, released their first half 20 results today, with a statutory net profit after tax of $6,161 million, up 34%. But this included a one-off gain from the sale of CFS-GAM, so it's not really meaningful. On a cash basis, the cost base remains under pressure from compliance, wage inflation and IT investments, plus rising insurance claims and provisions for drought and bushfires. But volume grew and consumer arrears are lower. And overall, this is still one of the best managed banks in Australia, but there are definitely some stresses below the waterline. Now, this cash result on a continuing basis is clearly more relevant, and it was down 4.3% on the prior reporting period to $4,477 million, thanks to stronger revenue growth than anticipated, especially from trading income, despite higher provisions and expenses. Operating income was flat at $12,416 million, while the net interest income was up 1.7% thanks to growth in the book. The net interest margin was 2.11%, up 1 basis point from the second half 2019, but they indicated that the lower cash rate will continue to impact net interest margin by around 5 basis points in the second half of 2020, and by a further 4 basis points across financial year 20 and financial year 21. Now, of course, the net interest margin is the difference between the interest paid on depositors and charged on loans. And non-interest income was down 4.6%, mainly thanks to the impact of bushfire-related claims at $83 million on insurance income, changes to wealth management fees, and hedging losses. And non-interest income essentially refers to fees and charges and other income sources. Now, operating expenses were up 2.6% to $5,429 million, with $630 million of remediation to customers paid out to the 31st of December 2019, following the Royal Commission misconduct and other required remediation. But a further $596 million is still outstanding to be paid. Loan impairment expenses were 17 basis points of average gross loans and acceptances, which is up 2 basis points, but that does include 3 basis points for drought and bushfire provisions. And they note a fall in consumer arrears thanks to the improved property market, but then said pockets of stress remain in the discretionary retail, agricultural and construction sectors. Provisions lifted from 1.28% to 1.34%, or $5,026 million. Mortgage arrears are down a little, though are still marginally elevated compared with prior years, they said. An exposure to apartment development has been reduced by 63% since December 2016, and Sydney represents 60% of the development exposure. The percentage of their book funded by deposits rose to 71% from 69% in the first half of 2019, and overall average wholesale funding is at 5.4 years. The net staple funding ratio improved 1% to 113%, and the liquidity coverage ratio increased by 3% to 134%. And the level to CET1 ratio rose by 100 basis points to 11.7%, and that means it's above the APRA target threshold. Now, this was helped by recent asset sales, and further divestment proceeds will assist ahead. And they announced a $500 million on-market purchase to support the dividend reinvestment plan, and they're not going to apply any discount to shareholders. And the bank declared a dividend of $2 per share, fully franked, which is unchanged from the first half of 2019. And management said that they'd make a further announcement on capital management in due course. This, we think, may be an off-market share buyback eventually. And while CBA remains committed to the absolute cost reduction that they announced previously, the facts are that this will be hard to achieve, especially in the light of more work to be done on costs, including risk management and compliance program spend, which were both identified as notable items in the report. And while CBA reported another half of very strong housing credit growth, which increased to 1.5 system compared with 1.3 times in the June 2019 half year, CBA attributed this partly to faster mortgage approval times and consistency in lending policy. But they said because they hold such a large part of the market, it makes this growth above system very difficult to sustain. And there has also been a shift from term deposits by customers to call deposits, which has saved the bank margin. And this is probably a reflection of the lower rates and greater flexibility that people have by not locking themselves into term deposits. But the net effect was a profit boost for the bank, which may not be repeatable. But the key point for me, above everything else, is the margin pressure expected ahead. So profitability will remain under severe pressure, and indeed several analysts have a sell rating on the bank after the results, despite the fact that there was a 4% hike in that share price today, which was probably the biggest mover on the local exchange, and puts it close, but not quite over, prices 5 years ago. And so in summary, banks are under severe pressure as the cash rate falls and net interest margins are squeezed. CBA is probably one of the more capable organisations to manage this pressure through its franchise. But even so, it is signalling it's going to be more difficult to maintain its profitability ahead. And this will, I think, set the benchmark for other lenders who are going to report through this reporting season. And frankly, I expect less good results from some of the other participants. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.